Confusion on direction led to rotation, which leads to opportunity. There's huge demand for uranium right now, but it's not for the reasons that you think. This rotation is creating a new class of leaders. But the confusion persisted with rotation. You can see where the 10-year is breaking out, pushing 4%. We're going to talk about why this is happening and what you need to pay attention to. Did the Fed act too far, too fast? The yen is imploding against the dollar, and why this spells trouble for industrials. We do have leading sectors that look like they're getting ready to lead again. We're at a critical juncture here for NVIDIA, and as NVIDIA goes, the NASDAQ. But are we seeing a new rotation into greener pastures? Meta's breakout might be one of those areas. And how does China fit into all this? And what are the names to look for in China? Have we missed the rally in China? And why this one graph has bond bulls crying? We have a ton to go over. Let's get to it. Hey everybody, welcome back. Ton to go over here. The move in and of itself was nowhere. We really went absolutely nowhere. And I think it's really important to understand what happened so that we can look at the end of the quarter and then go, okay, well, this is where we are and this is why we are where we are. So hopefully that makes a little sense. But we can all see this drop here right on October 1st. And this is really simple. This is just standard procedure from investment banks. They see it all the time, and then you can see it actually on the buy side too. What they do is they just blow everything out. And so you have that September 30 level, and then they just come in and go, oh, it's end of quarter, and then we're just going to dump everything and start over. So they lock in at the highest price they possibly can, and then you can see from there, all they did was just get out and the first thing Monday morning, or Tuesday morning rather, and just dump after the end of the quarter. Standard procedure. What we don't know is what's going to happen next. But if you take a look at our levels here, this 57.3375 seems to be like a pure bonk level where we're constantly hitting it over and over and over again, and we don't seem to find any kind of lift off of that. Now, the other thing that's happening here besides this area being of interest is this little wedge right in here is starting to become a problem. And I'm not sure what exactly happened Tuesday at 3 o'clock in the morning here, but you're starting to see that area be an area of interest. So we have a development here because you have a bunch of different little patterns. And what I like to do when this happens is start zooming out and looking at them, because sometimes you can get a little clarity. So whoever is here, probably very similar to who was over here getting out. And you can see that area becomes even more prominent when you do it this way. Drop it to a 30, and all you're doing is just keep going out and out and out until you get a really formed pattern. And then you can start seeing it and going, oh, kind of like a weird devil horns pattern, but not really. More of a devil horns over here, possibly, isn't it? And then you just go to the hourly. And all we've done so far and to develop this is just look at this starting from a 1, and now we're at an hourly. And you can see how this has developed. So do we have something here at an hourly that we need to be concerned about? Yes and no. I think on the ES in and of itself, the S&P 500, you want to watch this level extremely closely. 5,800 seems to be our nemesis for whatever reason. Here it was support, and then we came into the beginning of the new quarter, and now it's our nemesis at this quarter. We're really struggling with it, despite good news in the bond market or bad news in the bond market or rotation into other sectors. This doesn't mean that there's not opportunity. There is a ton of opportunity right now. We're going to get to that. But I think we'd be remiss to just not point out and be Captain Obvious here and say this is an issue. Now let's take a look at this a little greater. As always, the devil's in the details. So what we want to start with is that 830 bar and that non-farm payrolls data. As always, for those that are new, welcome, but I always mark off these 830 bars where we start to see some kind of behavior. In other words, the behavior that I'm looking for is the algorithms at high-frequency traders. A lot of people look at high-frequency traders and say you can't win, and I basically come out and say the exact opposite. They tell you exactly where they are, you just aren't listening. So when you look at these levels where this new data presents itself, it presents an opportunity for you to take a look and say, okay, well, what's exactly going on from that level? And this can really keep you out of harm's way, especially on big days, and present huge opportunity. For example, if you have this marked off and then you come to that 930 opening, you can see that that's exactly where you opened, tried to get over that area, complete Matumbo, tries again, Matumbo, it just never ever holds. And what we like to do is whenever those levels are marked, they become what we refer to as demarcation lines. So we know that we have an issue in here and it's something to pay attention to. Now, the bottom of that is, it's not a surprise. It's the same area where you tried, failed again, and then it becomes a battleground, and then eventually it makes a decision. This is a pretty classic area where you have the double bottom undercut and then the lift. If it's not rocket science, and they can usually see these things pretty clearly if you use RSI. I'm going to give you a couple really good examples of RSI today. I know a lot of people some don't use it, some use other things. I would strongly suggest that if you are day trading, which is really, let's get this out there, only really 25 to 30% of what I do. The majority is swing or long-term trading, and we're going to start covering more of that now based upon your comments. So I do read all your comments. They are very important to me, so keep them coming. But you see how you're making lower lows and now you're making higher highs here? RSI is the magnitude of the move. It's not possible for RSI to go up and this to continue for any period of time. It's not a question of if, it's a question of when. And that's why people and how people use RSI wrong. But just be aware of that. And it's something that I will get into and give you a really good example of that today. As always, your comments are appreciated on that. But if you just look at these levels, it's not rocket science. Let's get rid of Matumbo, rest in peace. But if you look here, look at that battleground all day. And here you are, and then here's the test, the retest, the test again, and then where they take you to the high, and then what happens? The rejection. Okay, so we know that these are areas of interest. We know that we lifted into the weekend, which is actually nice because we want to watch that last hour of trading. We always want to see what the last hour is doing because institutions act more towards the last hour than they do towards the beginning. They usually let retail feed upon themselves for the first hour of the market. And you can always see that. If you ever want to just split the market up in any way for yourselves, guys, just start dropping a level from like 10:30 in the first hour of the day and from 10 o'clock and just see if there's any kind of pattern that you start seeing with the market. Usually that first half hour or hour, you're starting to set your range, and then you'll start to see institutions come and get involved once that range is set. And this is a classic example of that half hour where you just, we're going to flush out retail, scare them, and then we're just going to buy what we want to buy. Matter of fact, even in the community, I commented on it, said they basically just let retail feed upon itself, and now it's go time. And when you start to know these nuances, it allows you to take advantage of it. This non-farm payroll data was really solid data, and we should probably get into it. Let's look at the immediate reaction of the announcement. So in front of us is CME Fed tool, and why this is so important is it shows you the percentage chance of what's going to happen. So we're going to look at the immediate reaction. We're going to then dive into the number, and then where do you see what happened later in the day. Now, this is the 100% chance of an ease. This is the current target of what they're shooting for Fed funds, which is, think about it as banks borrowing from another bank. There's an 89% chance right after this non-farm payrolls data came out that you are only going to get one cut, which is going to drop you from 450 to 475. And what this is really saying is that you could even just do nothing, but that's not going to happen. You're going to do something. They're going to cut 20. Then you have a 10% chance immediately following. Now, what's interesting is as they dive more into the number, you're going to see why they changed their mind and got completely rid of any chance of this happening. But look at these numbers and how they shifted. Now, let's take a look at this. Now, this is a great summary, and I always like saying where I get these things from so you can go look for them yourselves. This is from Reuters. But non-farm payrolls, we were looking for 140. Now, it was supposed to come out good, but we came out at 254. And we'll see the breakdown of this in a little bit. Unemployment rate falls to 4.1 from 4.2. Remember, we were concerned about, is this going to tick up? Are we going to see that 4.5 number? And we're clearly not going to see that number, are we? Average hourly earnings rise 0.4, up 4% year over year. So not only do we have more people with jobs, not only is the employment rate falling, they're making more money. Average work week is down a little bit, which is kind of interesting, but they're making more money. Now, you might say they're not. We can get into the validity. These are the numbers. Now, Reuters, they did a really good job of this, so I'm going to highlight some parts of this. The job gains increased the most in 6 months. It was really a blowout. No one had anything near this. And they're talking about now we have a resilient economy that does not need Fed Reserve to deliver large interest rate cuts for the rest of the year. This is exactly what you're going to see. This is the exact kind of behavior that you're going to see in this market. And you're going to see that this weekend from all the newspapers and all the pundits that, hey, we're way off on rate cuts. We were looking for 232. We're nowhere near that. In addition to the bigger than expected increase by the Labor Department, wages rose. The closely watched employment report also showed the economy added 72,000 more jobs in July and August. So we have data, and then what they do is they came out, took that data, and they increased that data, right? So the non-farm numbers actually went up from July and August. Now we have that level on the charts that we looked at a little earlier here This improved economic backdrop was acknowledged by Powell. So we have that level that Powell basically put a top in. And what he was saying is, we are not a policy setting committee that feels in a hurry to cut rates quickly. So he's telegraphing what he's going to do, and the data is now supporting what he's going to do. Hence why we're seeing certain sectors fall and others rally today. We will be addressing which ones to look at, which ones not to look at, which sectors are going to get hurt by this and which ones will not. Today's report reinforces the broad resilience in the theme of the U.S. economy, and you're going to see this over and over again. These economists are going to be all over the place. Their research will be out this weekend, and then they're going to hit you with it again Monday morning. Just be aware of it, but everybody's at 25 basis. No one's going to be anywhere near 50 by the end of the weekend, in my opinion. Non-farms increased to 54. This is the most since March, guys. The labor market, Bureau of Statistics, rolls at a forecast of 140, and it's even bigger than that, and we'll get into why it's bigger than that. It was broad-based. The shares of the industry reporting are 57.6, and again, what we're always looking for is the devil's in the details. So it's at 57.6 versus 51.8. Now, what's important about this is it's not that we had a non-farm payrolls number that shot up because government hired a bunch of people. Now, remember, when you look at a non-farm payrolls numbers, there's three parts. You have the manufacturing, you have the private sector, and you have the government, right? And when we start to see this breakdown, you'll see what I mean. But it was industries that did it, more industries. So the industries went up. So not only do we have an increase in non-farm payrolls, you have an increase across industries. Pardon me. Now this is where it gets interesting. They just cut an unusually large cut to kick it off with 50 basis points. And some economists wondering if policymakers panicked. A lot of people thought they panicked. If the Fed had known the revisions to July and August, this is the important part, it is very likely that they would have gone from 25 basis points instead. Now, what's going to happen here? As this comes out, you're going to see certain sectors rally and certain sectors sell down because of this. So did they just reinflate the equity markets by what they did? And a lot of people are going to start thinking, yes, they did. And you'll start to see this change in the way the CME Fed tool started to look at what they've done. So what we have is probably Powell's first step in about a year since he said he was going to stop raising rates, which was November, and their first cut was probably too much, is what's starting to happen, which leads a bunch of other questions that we could address. Boosted the odds of a quarter point by 95%. Before 71.5, CME Fed Watch Tool. What do you see what happened in December and January? It's absolutely staggering how it dropped. The Fed policy rate 50 basis points, 475 to 5. First rate reduction since 220. I think that this is going to be an issue. We'll address it. Also, remember, guys, this is the same crew that hiked us 525 basis points in a year. The fastest ever in the recorded history of this country. Now, to put it in perspective, below is the monthly change in U.S. jobs. Employers added 254, and as we talked about, we were looking for 140. If we take this level and you come across, it shows you how insane this number is. You've only had a couple other times here where we saw this number anywhere near this. This is a huge number, and it shows that we might be reinflating the economy. Now, from a trader's standpoint, that's not the worst thing in the world. But there's always something to pay later. But what you're seeing is private education, health services, leisure and hospitality, government, and we'll get to that, construction, professional business services, financial services, information. They even talk about it that you did see some of the professional services a little higher than expected, but manufacturing is just falling off a cliff. Now, I don't really agree with what he said, but I wanted to put it in here. So let's just take a look at what exactly is he saying. They're arguing against another 0.5%. Okay, in the November 6th meeting. He's like, well, they're going to have the October report, which is likely to be muddied by Helene, which is obviously the hurricane, and the Boeing strike at hand for that meeting. We do not see the firming in September as a risk of derailing the current downward trend of inflation. The issue with this is you actually have data to say that it is going away. And this is becoming an issue where we're seeing a reinflation because of China. So we have to pay attention to this because we're seeing it in copper, gold. We're also seeing it in oil. And that is inflation. It makes things more expensive. Hence, they are inflating prices. Hence the word inflation. The underlying trend of the labor market still seems to be gradually cooling. Well, what I just showed doesn't show gradually cooling, does it? So you do have some skeptics, but I think that they're going to change their tune. I think they're trying to figure out how to change their tune is what I'm thinking. Now, why it doesn't look like much, it's worth pointing out. So this is the monthly change in average hourly earnings, and you just come straight across, drop a line, take a look at a year, and say, okay, on average, month to month, when we're looking at this, are we in line? No, not even close. You were dropping, and then we had this huge spike, and now we're here, and you're at the third highest record of average hourly earnings increase in how long? Probably all year, the third one. So I think that there's something to say about this, guys. I wouldn't sleep on this kind of data. You want to look at how this is going to affect the market. This could be why we're seeing guys like Warren Buffett and other people go out there, Nike. Why are they changing their CEOs? It's almost like they're ramping up for a stronger consumer. Now, as the day went on, you can see what happens here. Here's November, and we can see right into November that you have a 99% chance now of what's going to happen? One cut. What happened to the chance of 50 basis points? It's 0. So you started the day with a 32% chance of getting a 50 basis point cut. You have to understand how significant this is. So you had a 32% chance right here of getting a 50 basis point cut. And now you have a 0. They don't even have it on the screen. They actually moved you to a 1% chance of nothing being done, which is kind of interesting because does this, that could be another question you need to ask yourself. Does it skew towards nothing's getting done by November? How much does this data skew? It's kind of interesting to think about, but certainly something that we should consider. We'll see how it plays out. But for now, please understand where you're at. Now, where do you see December? Now, if you look at December, what you'll note is you're at that 400 at 17% and 425, 450 here, 81%. So I'm at 475 and I want to get to 425. What you're telling me here is that I am either going to cut 1 or 2 times by December. And then here you're saying nothing but 1 is getting done between November and December. So this is an enormous change. And just understand what just happened. We went from 150 basis points when this whole thing started by December to we were going to do 50, 50, 50 to we just got a 50 done. Now we're at 475 to 500 as the target. The 425 target to 450 target puts 50 basis points in December. 25, 25. That's where you're at right now. Okay? That is the way that they're leaning you right now. And then you come here and we look over here, and now you're saying, well, wait a minute. There's actually a chance now that there's just 1 25 basis point cut. And everyone will say, well, it's only 0.8. Well, when this started off here today, you were at 11. Now you're at 0. This started at 44. Now you're at 17. This started at 43. This is at 81. You're in the first 2 months, and we've gone through this, and we're going to go over this graph again. You're in the first 2 months of an area, which is either going to determine a recession or increased productivity that leads to a very strong bull market as they cut rates into increased productivity. And it's the next 2 months since that first cut that determines this data that comes out. And so far, the data that's coming out is telling us that we're getting increased productivity. So we're looking for that to continue. But this change is pretty staggering. Now, if we take a look at January, they had you out to like a 325, 350, 350, 375, 15% of 350, which had you at about 125 basis points by January. There's 0 chance of that. You had a 44.8% chance of being somewhere between 100 to 125 if you look at it right in here. And then look at this 38% that went to 72. Now you're at 400 to 425. So they're saying at the end of January, you could, the optimal situation here that has the most chance is 25, 25, 25. That's optimal, right? So this is a massive shift, and this is definitely going to affect sectors. Let's get to it. Now, this is what I love about the action. This is the most critical time after a rate cut. I'm going to show you why it is in a second, but this is what we're saying. Here we are on September 30th, right in here. And let's get really into the nitty gritty. So you pop over, they pull the flim flam on the futures market and they get us over there, luring everybody to their hopes and dreams. And we know what happens there. Next thing you know, you're in your mom's basement eating Hot Pockets, right? They undercut you, snap us down. And now we have what I like to refer to as a control bar. And why is this a control bar? Because everything is in it. It's completely in control. You see how you're holding the bottom in here? And we're going to get to this in a second. Look at the volume and how the volume increased on Friday after non-farm payroll. And again, very important. You had more volume. Please pay attention to this part. And do I get into this level of detail? I do. And I'll show you how you can benefit from this in a second. Even with swing trades, it's very easy to do. But you see how you have this volume sitting right here? And you see how that volume marks September 30th? See how you're over that volume? And people say, well, it's options and blah, blah, blah. No, it's after the non-farm payrolls data. You had more buying after non-farm payrolls than any time in the futures market going all the way back to September 12th and 11th. That's how far back you'd have to go. And even after that, if you take a look at this, look at where you're at. You only have a couple outliers for a whole month. So to blow off Friday's move as, oh, it's just non-farm payrolls, is a huge mistake. If you look at this and then drill into it with just the simplest of things and look at a 22, a 55, and a 12, you can see that we're back over the 12. Get a little further into this, and I use these and I overlay them in 6.5 hour increments. So in other words, what I'm doing with them is these move every 6.5 hours is a day. It's a little more complex than that, but really what you're looking at is a 3, 5, and an 8, and then I just break them up into 6.5 hours, which is really a trading day, and then just kind of look at what's going. It tends to work for me and catch moves ahead of time. But look at what's going on here. Green is go, yellow, stop, right? You get it, 3, 5, 8, and then they flip colors. And look at what you're doing here. So I always pay attention to this, and sometimes what I like to do with it is just come here and just hide what the candlesticks and just look and say, okay, well, what's actually happening here? Which way are we going? And you can see the break here in the left. Now, does that always mean that you're going to do this? No, it doesn't. But it's a sign, and I would suggest that you pay attention to it. So it is something that I look at and then go from there. I do like it, and it does tend to give me an edge. Now, with this done, this volume that we're seeing, people are going to look at this and say, oh, we're not going anywhere. And I agree with that. You have to go back to, what I've been yammering on about for some time, which was from this break, what do you have? You have that CTA sell zone in here that's been the crux of everything, even to the top of this. And we all remember what this bar is, right? We all know that this bar is that negative CPI month over month. So really, when I expand out my CTA range, it really encapsulates everything in here. So does this mean that we shouldn't be in the market? No, it's very possible that the NASDAQ goes sideways and rebuilds as certain names become leaders. And this is what we need to talk about. You need to understand rotation. You need to understand theme. This is a really important part of the process if you're going to be successful at this. Now, one of the core things that I would focus on is the stool, and it's one of the things that I do. I look at the macro, I look at the fundamental, and I look at the technical. And this is the world of us trading right up here. And it's really important to get this kind, because everybody will just look at the technical and say that's it. They're not understanding how the macro is changing the fundamentals of companies. Remember how we look at this. What, who, when. So what happened in the macro world? Non-farm payrolls. Who's affected by that, right? When are they going to move is when the technicals tell us. Understanding and connecting all three of these are how you become successful. The people that are just looking at technicals and trading technicals, yes, you can totally do that. You can absolutely do that. You can make some money and get in and out. But to get the themes that are going on under the hood, you need to start understanding the what, the who, and the when, because this will tell you where the drivers are. And people will say, well, that doesn't, I don't need that. Well, you do, because then you would understand why VST is one of the top performing stocks out there right now. People will say, well, it doesn't make any sense. No, it would, because you'd be looking at commodities and you would have seen this start to move. And then once this starts to move, you would understand that this is moving, not just because of what's going on a macro front, because of what's going on in a fundamental front. In other words, when you go back and remember that CEG is breaking out because of two major factors. Number one, we went over this 2 weeks ago, and I'm just going to give a refresher. We're not going to get all into it. But number one, they partnered 20 years with Microsoft. Number two, they are referring to nuclear energy as carbon negative. That is very specific language. Why are they doing that? Okay, they're doing it because they're going to start getting paid and tax write-offs on it. Watch what happens. They're going to start converting this to, we're getting, instead of carbon credits, we're going to get some kind of tax break. The lobbyists will come in. That's where they're going to go with it. 3 Mile Island is now the Crane Clean Energy Facility. Okay, you're not getting any of this if you're not following the macro and the fundamental changes. You're just looking at a chart and buying it. And that by doing that, you're buying this on the breakout after you get it, and then you're missing the bigger moves. Right? You're not looking at where the puck's going. You're looking at where the puck is, right? So people are buying CEG, not realizing that VST is going to outperform it. We understood this. So we were able to get in VST. And I'm not suggesting that it's not great to be in the leader, or in the leading sectors. But if you're going to put your money to work, you want to get the most return for your money. Right? It's just a fact. It's just what you want to do. So there's a reason why NRG is a lower beta mover. And we know that these names exist because we've been talking about this AI power move, and we've been breaking it down for us in different sectors. These are all independent power producers. You're not getting this if you're not following the what, the who, and the when. If you're not watching where this is all going, you're not going to catch these moves. This is a really important concept. You might want to listen to it a couple times. This is how you become one of those people that goes, I'm going to follow the themes. Okay, and the themes are what makes money. Index, of course. Sector, yes. And then you're drilling into stock. Doing this is going to keep you well ahead of everybody else. and keep you in tandem with what's actually going on. This is the difference between buying NRG, which there's nothing wrong with, you're making money, and buying VST. You can also do this with technicals on a different basis, but understand this concept. You might want to watch this again. Now let's get back to the NQ and focus. So if we look at the NQ and we understand that this is the range and this is where we're going to be, we have to understand that we could just churn in here for the next 4 weeks. There's no guarantee that we're going to break out of this. There's no guarantee we don't come back and test in this. But what we do know is that certain sectors and subsectors are starting to break out. And we must pay attention to that. For example, if we look at the SOX, people are saying, oh, the SOX is done, right? The SOX is in a trading range. It's not, in my view, setting the world on fire. But there's a couple key things to look at here. And I do view these as areas that are part of the stool that you have to pay attention to. So here's the 55. I'm not breaking it. No matter what we say, here's the breakout, here's the retest. There's no confirm bar, which would be a lower low. And what are you doing in here? You're just sitting there. Test, test, test. So again, you want to watch this area, but I could make an argument that this is a control bar and you just closed above it. So I do think that this is something to watch. And then we start getting into NVIDIA, of course. And again, let's get rid of Sarah. But if we take a look at what's happening here, we bought this as a swing trade right in here. And what we did with it, just holding on to it, right? Letting it do its thing because it's a swing trade. And again, I trade multiple accounts and I trade multiple time frames. So, if you're going to day trade it, then day trade it. If you're not going to day trade it, then do what you say you're going to do. I'm going to do a whole video on this because I think that this is where people get really confused without understanding what kind of trading they're actually doing. But you see how these DTLs are sitting there? Now, I would prefer, I love dragonflies, which you open and close at the high of the bar. Love them. I don't like it if they're not green. So it doesn't make me feel warm and fuzzy. I would prefer it to be green. People will be like, you're splitting hairs. It's still a hair, and it means it needs to be split. So I need to watch this. I would have preferred something more emphatic, but I am long this. We've been in since here. You go to the retest of the DTL, you come back and look at what you're doing. And this is really important because when you see these patterns, you can benefit greatly from them. And I'm just going to point them out. Open undercuts 55, pushes back and closes over. The undercut and over allowed us to get an add to the position because it confirmed the breakout. The next day you gap up and now we're still in it and we're longer than we've been. This is a really important concept. Okay, it's the undercut, then back over the open near a 55, especially on a retest. You want to pay attention to that. So if there's anything technical to take away from this video, that's going to be one of them. I have 2 other things I really want to go over technically. We need to shift our focus for a second before we do that. Now, as some of you know, these videos are pretty much done off the cuff. I make notes and go from there. So we do move around a little bit, and I don't have time to edit it. As far as that, actually, somebody may be a meme. I'll show it later. But I want to go through why I go through what we just went through. In other words, why do you care about non-farm payrolls? Like, you're sitting there going, whatever, boomer, just tell me what to do. So if you look at these and see how this is going. Why do I care about this area? This is your first Fed cut. This is from Goldman. This is your first Fed cut, and then you have 60 days out from there. Those next 60 days are everything. And I'm just going to say that again. Those 60 days are literally everything. It's going to determine how everything goes. So from that point on, from point 2 up, if you just take a line and just drop it, you will start to see that you start splitting right in this area, right? You can start seeing you're either going to go up or you're going to go down. This ties us right into that election area, doesn't it? And that's a really important part for us to remember. So if we're going to go into a recession, you're going to start seeing signs of that with the economy. If you're not going to go into a recession, then you're going to start seeing signs of recovery after the cut. Now, number one, there has never been a time in history where we've had someone raise rates the way that he has, ever in history. We've also never had somebody put trillions in the stock market and have to reduce the balance sheet. Okay, so is this warranted? We can all go back and Monday morning quarterback him on injecting trillions into the market, but who knew what was going to happen? So he gets a pass. But now you're at a point where there's a bill to pay for that, right? And so now we're trying to see, okay, are we going to get this from Itchy, or is this what's going to happen? And we just don't know yet. So what we're doing is, this is why we're diving into non-farm payrolls. This is why non-farm payrolls is so important, and why the market moved, and why everything moved the way that it did. For us, understanding this is the reason why. Okay, knowing that, hey, are we going into recession or not? See, a lot of people put out graphs where they'll say, oh, the first rate cut, and then that's it, you come down, and then it's going to be just like 01 and 07, and this is what you're going to get. Okay, what about 87? What about 95? What about 98? I mean, I was trading in 95 and 90. It really started in 95, and I was like 22 at the time. I'm in my late 40s. So if you see how this is going, right? We killed it in 95. We killed it in 98 when they cut rates. And it was because we had increased productivity. And that's exactly what you have going on right now. Does increased productivity continue? I don't know. No one has a clue. But right now, the answer is yes. So right now, this is the trajectory and the path that we're on. Could we switch to this? Yeah. But the longer that this goes on, the more the probability that this is the path that you're dealing with. And that's what we have. That's all we have is probability and assessing risk the entire time. So until we get data that says this is coming, I'm going on this path. Now, fortunately, if you don't like the US path, you have other avenues right now. The only country out there that I can see, and they're also saying that UK is doing it, but the only country out there that I really see that's doing this is China. And they are reinflating. What China has done here is the equivalent of something that we did in 2020, which is their pandemic stimulus. And that's why this is moving the way that it is. We're not going to get into all of it right now, but I do want you to understand that that is why it's moving the way that it is right now. And this is how people are judging it. So if you think about this from the simplest of terms, they came out with the stimulus here. People didn't fully understand it. When they explained the stimulus in greater details, that's when this happened. And it's been ripping ever since. You can see which names are moving, and I will spend a little time getting into those names, but I think that it's much more important to understand where the valuations are with China so that you can make a more informed decision. Now, number one, China trades at 9.5 times a 12-month forward PE. It's a 23% discount to the MSCI EM, which is the emerging market. Sustainable re-rating hinges on fundamental and earnings improvement. So this is roughly one standard deviation. Implied PE of the emerging markets is right here. This is where we're at. It's important to get this so that you understand and have a general knowledge of how cheap China is. Love it, hate it, whatever. The bottom line is understand that this is where you're at right now, and you're at a huge discounts to the rest of the emerging markets, and they are reinflating their equity market. I don't know, I haven't seen a lot saying how this is going to translate to GDP, but the one thing that's very clear is it's definitely going to hit their equity market. That's an important distinction we'll get to in a second. Now, why China is so important, if you look at price to book versus return on equity. So price to book is what something is trading at for its underlying asset. Return on equity is the amount of money that you put into it and then what you get for that. China's current valuation discount versus the trends it's likely to sustain. And what they're suggesting here, and this is from Goldman, is what they're saying is like, okay, if things got bearish, then you're going to trade under book value, which is pretty insane when you think about it. So just to kind of put this in perspective, okay, you have Korea that's sitting right around here. That's not really there, right? Here's Hong Kong. And then you go here and go, okay, so Colombia and here we're trading under. And here's where you're at now. So what I want to do with this graph, and I think that this is just an important second of our lives, is just kind of go here and draw this line across and say, okay, well, this is where China is and who's below that line. Now, forget where the names are, but just look. So China is currently trading at the same price as Colombia, Chile, and Korea. Obviously, these are higher, even though their names are here because of where their dots are. Just let that sink in for a second. And then you look at the return on equity on where China is now and what people are getting. And then we would come over here and go, China is Malaysia, Japan, China, Korea, and Hong Kong versus everybody else over here. Just so we're getting the fact that the return on equity and trailing price to book is higher in the Philippines. All right, so it puts this kind of into perspective how cheap the second largest economy in the world's stock market is trading. Hopefully you get what I'm saying. I'm not saying it shouldn't be there. The price is the price, right? Things are what they are, okay? There's a reason that there's a price for it. But it does talk about that, hey, if they got it together and turned this big ship around, where do you wind up? Are people getting invested? Yeah. If you take a look at the daily turnover, you're hitting historical highs. It's absolutely insane. And the reason for this is because people realize that this is a re-inflation trade. Now, there's a lot of people saying that it's not going to affect GDP 24, 25, but it doesn't matter with certain names. Certain names are going to absolutely explode on this, and we're going to get to that. Now, this is an older graph, and if you're in the community, you've seen this before, but I wanted to throw it out there, even though it's a week old. If you take a look at what's going on and what prime book is, this is what hedge funds, this is where they put their money. So if you're a big hedge fund, you don't keep it at home. You keep it with a prime broker, and that's called a prime book. And what this shows you is our hedge fund that are housed at this organization, are they buying Chinese equities? And the answer is, yeah, they can't buy them fast enough. A matter of fact, they're buying them on a notional net trading volume faster than any time in the past 10 years. And a Z-score, just so you understand, think standard deviation whenever you see Z-score. So a second standard deviation is like a 95. Third is like a 99.7. This is pretty much insane. Okay, so this is not, when you see something like this, you don't see it very often, and that's why it's inflating the same way. Now, if you look at retail will tell you, oh, you've missed it. I don't think these guys are putting billions and billions of dollars into this thinking that they missed it. Sentiment Trader put out a great chart here, and this chart, from my perspective, really hammers it home. And it's just, this is the breadth, HSI. And what I would suggest also, if you want to follow the China market, just put HSI on your screen and just follow what's going on. It's so easy to do. You can actually even look at the futures market, and you can do it right on TradingView. Just go, HSI futures. It's very simple. Breadth. Percentage above the 10-day moving average, excessive pessimism, excessive optimism, and then back testing what happens when you get over. I think it's just important to note that just because the breadth is over doesn't always mean that you're just going to miraculously go up. So you could have the breadth spike like we did here, and then we just roll right back over. But historically speaking, it's a place of interest, right? Now, do I think it's going to be the place of interest here when you're spiking like this? Not really, no. I do think it's worth noting that the breadth is absolutely insane now. And why am I pointing it out if I'm saying, well, there's nothing to it? I'm pointing it out because you have to realize that when you're up here, just like our markets in the S&P, you're going to have pullbacks. And to me, these pullbacks are going to be all over the place. They're going to have missteps. They're going to do things. So do you have to chase? I don't think so. I think you have to know where the money's going and what sectors are going to move. And I think it's worth noting again that this is the 50-day moving average on a percentage basis. This is from Sentiment Trader. It's going back 20 years. If you start looking at these levels that are marked here when you're all the way over and everybody is giddy, okay, sometimes they're going to mark tops and sometimes they're going to mark bottoms. It's very hard to use this one and say, oh, look, it's the great financial crisis. And then, oh, look, we're kind of skewing that way, right? This is different growth that's going on here. What you have to do, in my opinion, is understand that when you're this high, the probability that you're going to stay here is not great, and you're probably going to drop. And so why go through these? Because the purpose of me showing you this is, do you want to chase? Probably not. You probably want to wait for pullbacks and then get involved, and then you have to look at what sectors are actually going to move from there. Now, one of the things that I did, and if you're in the community, you already know this, you have a list, and I created it, and we just marked it. I took 110 of the most popular names, and we put them together in a list, and we've just been monitoring them. Now, what is happening is pretty much not what I think people think is going to happen, and I'll show you what I mean by this. So if you take some of these top names like PDD, for example, and you go out there and you put Baba in, we're going to put Fudu in for a second. And these are names that are flying, but there's a section that's really flying, in my opinion. And I think that this is really where you should focus. And then there's a way to determine which one of these is actually going to be the best. So if you're taking a look at this and how this is moving, and let's just go to this 1 minute, let's drop it to a 15, because that'll be easier. And you'll see how they lifted and now how there's some are breaking out over others. There's a couple of things you need to remember about China. Okay? The first thing about this, more than anything, is we don't have research on a lot of these companies. You just don't have research on them. But what you do know, and we could also throw QFIN in here because I think that'll be helpful. But what you do know is that they're trying to reflate the economy. And if they're going to try to reflate it, what that means is the underlying assets are going to go up. If the underlying assets are going to go up, no one benefits more than who? FinTech over there. Nobody is going to benefit more from it. So why people are looking at the Babas of the world or the PDDs, and I do own some of these names, the real money is going to be made on the finance bros. So it's the FinTech, it's Tiger, it's Futu. That's where the real money is going to be made on these. And people are considering that these moves have already happened. Yes and no. If we go here, for example, and this is what we did on Friday, and let me just walk through it, clean this all off. What we did on Friday, we understood that a lot of these names, a lot of them, you're not going to understand why they're moving. You're just going to say, oh, they're moving too fast. But you don't really know the underlying assets of this company. You don't have a clue. The only thing that you can do is just look at where the volume's going, because someone else knows more than you do. And I hate to be that blunt about it, but it's not like you're going to get research from the Asian markets from JP Morgan and they're going to break down Tiger's real book value and how they benefit from this reinflation. It's just not going to happen. So I have to use the tools that I have access to. The number one thing that I have access to is my brain and using volume. Okay, so when I look at something like this and you see this and all this volume just starts pouring in here, and then all this volume again, and then out of nowhere, just in the middle of the day, you just start seeing prints of like 2.5 million. all right? When you start to see this, it presents opportunity. And then what you do is you overlay these with the other names. So then you start looking at Futu. So when we wanted to add, we had to figure out which one to add to. This became very clear which one to add to. The one to add to was Tiger. Now people say, oh, it's too high. I agree that it moved a lot. And I'm not suggesting, oh, you need to get in right now. We did get in cheaper. But like what you have to understand about this is if you don't have this on your radar and you're not looking at this, then you're missing where this is going. And that's a really important concept. People are going to say, oh, well, it's already moved so much. Okay. And what? What does that mean? Does that mean it can't move anymore? Because it sure looks to me like people are trying to still get in these trades. And so, yeah, we have double-digit returns on it already, but am I getting out of all of it? No. Am I trading around a core position? Yeah. You're going to want to do some due diligence on these kind of finance names and take a look at them. When you start understanding where these things were and where they could possibly get to, and I'm not talking about, oh, we're going to 40 or 50, but what I'm suggesting is that just do a little due diligence as much as you can on the fundamental side, understand the macro reinflation trade, and then look at the technicals on where you're going to get in. If you're out there trading and you start seeing things like this, and then out of nowhere, you just start seeing someone buying millions and millions of shares, okay? That's not Freddy Fingers on Twitter. Okay, that's an institution going, you know what, they benefit from this and this is why. And so you're going to have to look for signals like this. So I want to go through a concept here, and I think it's an important concept for people to get. And I see this a lot, and I see people doing the wrong thing with it. So I want to just point it out because to me, these are so obvious. And I think as you get more familiar with them, that you'll start to see it too. They keep taking us to these levels and then they reject. And Tesla's a great example of this, where they're doing it over and over and over again, and people just keep falling for the banana in the tailpipe. So you want to keep marking off your core levels and you want to keep watching those. This provided a huge trade for us. Actually, we gave 2 of them. But by marking this off, it was really very clear. And then you can see how, let's get rid of that one and we'll go back to it. And you're going to see how this VWAP acted. But the VWAP wasn't the trade. And people are going to get a little confused by this, but I want to point this out. Get rid of everything and just look at price. So what you have here is classic movement. You know that this is a resistance point. Once you flip, it's on. You do the undercut. So what they do here is they get everybody on the 1-minute opening range breakout trade. You buy it, rejects. They flush them all out, and then they rip, right? Some people will buy that bar. It actually makes a lot of sense to buy that bar. Candidly, if you're looking at the long side, you're watching the retest. For me, I always look and saying, okay, well, where can we get to? And this was an area of rejection. So to me, I really wasn't thinking about it that way. I was thinking that we had the potential to gap fill like so many other names gap filled. So I was looking at the short side of the market. And what I saw is really very simple. You have this ability to rally. Once you rally and then you fail the rally and you try to re-rally and you fail. So you have your test and then you're trying again. Once this bar formed, that was it. It was very simple to look at this and go, okay, we tried. And all they did was sell into this area as soon as they can. This is a massive reversal pattern, and I'm just going to show it to you. You have your opening, you push forward, you close at the low. It doesn't get any clearer than that. I'm not waiting for VWAP. I already know that VWAP is going to be an issue, but I'm not even waiting for it. All I'm doing is putting this trade on and then just getting out of it and then watching core levels. My process with this was just to take a look at it and see if I had the potential to gap fill, because you saw other names start to gap fill. We saw Meta gap fill, we saw Apple fall apart. So you started to understand like, hey, we could actually gap fill on some of these names. The other thing that becomes increasingly clear as you do this is areas of interest. Now, a lot of people, when they look at RSI, they're looking at it the wrong way. And I'm just going to point this out because I saw a lot of this, not only in the community, but I saw a lot of it just in talking to people when people say, well, I look at it, it doesn't do anything for me. This kept you out of harm's way. So when people were looking at this breakout and they wanted to get involved, and I'm going to clean all this off now. When they wanted to get involved right here, what started to happen, it became abundantly clear that you had a negative divergence. And anybody with a set of eyes that knows what they're looking for can see this. So it's not, and just understand that RSI charts magnitude of the move. It is not possible for and listen to the words, sustained rally with the magnitude dropping. It's just not possible. So when you understand what these things are, you're going to see this stuff and go, okay, I don't know when this is going to break, but it could be at 52, 53 before it happens, but this is out there. And if you're watching this get worse while you're sitting up there, it's a no-brainer, right? So when we were in the community, I was just telling people to be careful, and then you can just see how it followed. And then again, what are you doing? Are you falling apart? And this is the important part about the market. as a whole before I get into this and show you this live, specifically this section and how to do this trade. And if you like this, let me know. A lot of people said, you're not showing trades anymore. I tried to make these more educational and informational, and then I was trying to do the trades in a separate video. I'll go back and forth with it based upon the comments I'm getting. But I do want to do a separate video on this particular pattern because it's really important. This divergence is also important. But note one thing here, you're not breaking down. Okay, so the market in and of itself, if we look at the structure of the trading that's going on right now, even if I'm shorting this, I must understand that the market technically and these names are not breaking down. Let's watch this play out live. Are we finally there yet? Because this is exhausting pretending that I don't want to short this thing. 247.5. What are we going to do here? We're going to do this trade. I'm short and I bought a bunch of puts in Tesla. I'll know very, very fast if I'm right or not. So it's a really interesting spot. I've got my first lower low. I do think this has massive potential. It's why I did it. I think you could gap fill today. 82 on those already. Let's pull something out small, 90. So 20% pulled something out. Sold some more. I'm trimming as this is dropping because I'm fighting the tape. You know that. Trimmed more. I think that there's just so many people in this. It makes it so difficult. That's why you got to pull money out right away. I trimmed more and I'm just going to put the rest to break even on those puts and leave them alone. I'm pulling stock out on the way down and I'll probably leave some stock for the high, but I'm making sure that I make money on other stuff to pay for that. So I close some puts there in case we bounce. You really want to go negative here, and I don't know that we're going to. So I'm going to pull something out. Trimmed more of the Tesla short, and the rest of those puts are break even again. On stock, I'm only up like the most on any part of that, about $2 on the short side on the stock. $3 trimmed. The 275 puts I trimmed. Trimmed stock into this too. Just trimming stock the whole way down. Up 100%. Trimmed. Still break even on the rest. As a stop. Easy money on Tesla's made. I'm out. I got a runner on stock only. Back to break even, which is like 248.5 right here. But 100% of the options. When you start to see these concepts, and I want to go through this as well, and you start to understand them, specifically in regards to RSI or those kinds of breaks, you're constantly looking at other charts to see if you can find spots that start to become a place of interest. Like, for example, this is following perfectly on this weekly on Meta. And so you know you're at the high end of the range. You also know that Meta's been basing for a period of time. You also know they have those weird glasses. I personally think Meta's moving for other reasons. I can get into it in another video. But that's a classic breakout of a multi-year base. So let's just be real clear on where Meta's gone this year. You had this move in January, and then you haven't gone anywhere. So if we take that and realize that the majority of the year on Meta has been this range, between 540 to 440, roughly in there. That's all we've really done, right? We haven't really done more than that, have we? And you're breaking out of this. You could see how something like this might just be beginning. If you look at this on a daily and you go from here, you could see how it might just be beginning. And you're going into this quarter of earnings. What's interesting about this quarter of earnings is back here is when they made a huge investment in AI. And I guess we're going to see if that's going to come home to roost and that if they're going to make any money off this investment or not. But this is what we're seeing, and we're starting to see the lift. I do think it's very, very important to point out a couple things. Number one, if you look at Google here and you see how Google's acting and you just drop this down, Google's still holding in here. But these are the XLC names. And when we look at the XLC names, we can start seeing them lift. So is this the new sector to look at? We saw this with IGV too, guys, just FYI. You saw IGV start to really reclaim itself here. The Nows of the world, right? They're starting to pop out again. The Oracles of the world are starting to pop out again. You're starting to see this kind of movement. But what this does is when you start to see this kind of stuff, on Fridays in particular, start watching your Fridays at the end of the week again as we're starting to come out of this range. As I explained at the beginning of this, you're going through something here, guys. You definitely are going through something where you're trying to figure out, are you going through a recession or are you not? And then as it becomes clearer that we are not, which is the camp that I'm in, it presents opportunity. So we had like a little trade here the other day, right to the close, and it just made so much sense. Let me see if I can find it very quickly. And so what we're doing is I'm just looking for areas and ways to get in this trade. I'll show you how I got in this thing. But 247 at the end of the day, we start buying like the 12-cent calls, and then I just max out at them when it's at 20 cents. Then they went up to 40 cents. I was laughing at how easy it was, but like they were just priced wrong. And I could do a whole video on how I price options. It's very different than how people price and use Black-Scholes. So it's not even close to how people use Black-Scholes. But like sometimes I've been doing it long enough, and I was a registered options principal for 9 years, so I kind of see some of these things. And I think I see discrepancies differently. But anyway, or risk to the option market maker differently. Let me put it to you that way. So as we were looking at this, I'm like, well, this is just silly. You could be in the money in like an hour, like very easily. You had blue skies above. And when you're looking at this, all you were doing was just grinding in tandem. Like that's all you were doing here. And then you start looking at something as simplistic as the volume on top of that. All your volume was picking up. So your volume went away and then just started increasing. So whenever you start to see this at the end of the day, especially names that do this, you really want to pay attention. And so one of the key indicators you're going to see here in rotation, which is really one of the themes of today's video, is you have to watch this stuff on these breaks and start looking for where are we rotating. I just gave you 2 sectors that you might want to watch. So we bought these things and then we wound up getting out of the rest of them here, but it also presented me a really cool opportunity. And I'll show you what I did with them. So like at one point we were up 1,000% in them. And I like showing the timestamps specifically for not look at me, but to actually say, hey, we actually did this and they're timestamped and it's recorded. But what's interesting about this is I want to own the stock. So what this allowed me to do, besides anything else, was I could get assigned. So what I was trying to explain to people, like going into the close, like, hey, one of the reasons why some brokerage accounts won't let you buy these into the close is they'll look at the account and go, well, you have the right to be assigned this stock. And we need to make sure that you have the capital to be assigned thousands and thousands of shares of Meta, especially if you're buying them for 12 cents, you'd be buying thousands of calls, right? So you need to make sure that there's ways to talk to your broker about it. Some brokers will waive that if you give them, you can give them clearance to just close you out at 4. Some brokers won't care what you say and they're just not going to let you do it. But I wanted to be assigned at the end of the day. I wanted the stock. And this gave me 12 cents to get in. So I could control, it doesn't matter how much, a lot of stock for 12 cents and then hold it over the weekend. And now I'm in a position here, watch. Now let's clean all this off. Now I'm in a position here where I own this stock going into Friday and I'm breaking out on above average volume. These are really important concepts and we're going to start covering more of those. You might want to watch one of these 2 videos. I go into very specific price action patterns in both of them. Your comments on them as well are greatly appreciated. And as always, any questions, reach out in the comments. That's it.